Invest for a living, there are always going to be smarter people than you, and your club membership can be revoked at any time. We're also in it for the emotion. There's nothing like the rush you get from seeing a bet pay off. Problem is, that feeling is literally addictive and can lead you to take bigger and bigger risks. Eventually, that catches up to you. So, is being dull looking a little better? Alan Roth, whose column runs right here on CBS Money Watch, praises the virtues of a dull-as-dishwater approach to investing. Had you invested in moderate amounts in 3 basic index mutual funds and rebalanced your portfolio as you went, selling some of your winners and buying some of your losers every year, you'd have emerged from the crisis with more money than you had going in. That's right, more money, even in the crisis.
What's going on? There's a panic. A panic is when you get panic on the upside, as you got in 1999. It kind of lasts longer. Greed is a longer-lasting emotion and hope and stuff. But now you have a panic based on fear, and it's painful. I mean, people can't sleep at night. It results in a really uncomfortable feeling. I feel it myself. How can you not? I mean, you're getting like this. And so the thing is, I'm disciplined over the years to not sell into a panic, but people are selling into a panic. Panics, by definition, are self-limiting because eventually the selling exhausts itself sooner rather than later. We're in a panic that is in the process of exhausting itself. I was hoping it would be today. It wasn't today.
So do you two agree that this is, we're seeing panic? I mean, is this what's called capitulation?
I have no idea, but I would say I'm sure my technique would work will work very, very well, but it won't if you try and pick a bottom.
Okay, so don't try to pick a bottom.
You buy when values are good enough, and the companies are safe because they're eminently creditworthy. And the third thing is they have prospects for double-digit growth.
Is there a meaningful distinction to be drawn between making money out of investment and making money out of speculation? It's always a bet, isn't it? It's always a gamble.
No, it isn't a gamble. There is a real distinction. Basically, it's subjective, but an investment attitude, you look to the asset itself to produce the return. So if I buy a farm and I expect it to produce $80 an acre for me in terms of its revenue from corn and soybeans, and it cost me $600. I'm looking at the return from the farm itself. I'm not looking at the price of the farm every day or every week or every year. On the other hand, if I buy a stock and I hope it goes up next week, to me that's pure speculation.
Well,
David.
Royce has for 40 years had a very disciplined approach to investing. And like Tom, I agree that volatility is the friend of a disciplined approach. It creates opportunities to add to positions that are high conviction. We have a very consistent strategy, which I think also mitigates the volatility. We're focused purely on high quality smaller companies. And they tend to be dividend-paying businesses, which is quite a bit of a cushion in a downturn. In terms of quality, we invest only in companies that have very strong balance sheets. Specifically, half of their balance sheet needs to be funded by shareholders' equity, so that's a very strong balance sheet. Businesses that generate consistently high returns on invested capital, we use a 15% hurdle. So these tend to be self-funding businesses that take market share in tough times. The dividend picture is also quite encouraging. I think people don't always associate this with smaller companies, but 85% of the companies held in the Royce Global Value Fund are dividend payers. And dividends have actually, since 1930, dividends have accounted for about half of the return of the S&P 500. So dividends are a huge portion of the picture that I think a lot of people miss. So we don't really change strategy in this sort of a period. In fact, we were talking before about, should we be at the office or shouldn't we? It's good to leave the office on a day like today when the markets are down, 5%. We stick to a strategy. We may add to some positions that are particularly high conviction, but so we're not changing anything, but really just, sticking to our guns essentially.
In a highly publicized way, is anybody that is long is an idiot, anybody that's short is a genius. Anybody that didn't see it coming is an idiot, and Nouriel Roubini and people like him are astonishing geniuses. And the problem is, as I said earlier, nobody's really good at forecasting over time. That there are a lot of people that can call one recession or one bear market, but inevitably they get they get hung up on overstaying their welcome or looking for the same thing to happen more than once, and history doesn't exactly repeat. So our view is it might recover and it might stay awful, but to be safe, to have that margin of safety in our investments, we want to assume that it's pretty darn bad, and we want to assume that for quite a while.
I think that companies that are fundamentally conservative in their approach, they have a good balance sheet. They're not using leverage. And oftentimes, if you find that the people who are running the company have skin in the game, and it's not that they weren't given their stock and options, but there's sweat equity. People behave a lot differently when it's their money. And if, a lot of the big frauds have been people who wanted to go make a big killing and move on. If it's their dough, whether they're based in the U.S., Switzerland, or in the Far East, they behave differently. And I think that's...
Yeah, and that's a little bit like, I've got this rule, the first rule is don't lose, and the second rule is never forget the first rule. So it really isn't so much having a lot of brilliant decisions, it's just not really having some terrible ones. And frankly, I did learn from Ben Graham how to avoid ever having any disasters in investments. It wasn't that you were going to come up with the very smartest thing, but if you never have any significant losses, some singles and doubles will produce a lot of runs before you get through.
Who was Ben Graham? He was your primary mentor, model?
He was a wonderful man, and he was my professor at Columbia. I read his book when I was 19 at the University of Nebraska, and I'd started investing when I was 11, and I started reading about it when I was like 7. So I'd gone through I read every book in the Omaha Public Library that there was on, by the time I was 12, on investing and stock market. And I had a lot of fun, but I never really found out, I never got grounded in anything. And it was entertaining, but it wasn't going to be profitable. And then I read Graham's book, The Intelligent Investor, when I was at the University of Nebraska. And that just opened the whole thing up to me. Yeah, and I named my oldest son is named Howard after my dad, Graham Buffett, and he was a marvelous man. Never expected anything from me in return. He just did all these things for younger people.
You have just a couple of quick examples of the things that he did that you will look back on. It's one thing to read something, but quite a